Most small business owners get crushed not because their idea was bad, but because they ran out of cash during a crisis. One slow month, one surprise tax bill, one broken machine, or one delayed customer payment can cause payroll delays, loan defaults, and credit score damage. In this video, you will learn 4 types of emergency fund for your business. Also, don't ignore Type 3 emergency fund. Type 1, Operating Expense Emergency Fund. This fund protects you when sales drop, invoices get delayed, or market demand slows down. It covers basic operating expenses such as payroll, rent, utilities, software, subscriptions, insurance, and minimum inventory. Think of it as survival fuel. A practical benchmark is to maintain 3 to 6 months of OPEX as your liquidity buffer. For example, if your business spends $20,000 per month on basic operating expenses, then a 3-month OPEX buffer equals $60,000. That money sits in a liquid instrument, such as a high-yield business savings account, treasury bills, or a money market fund. Liquidity matters because during emergencies, you need instant access without penalties. From a finance perspective, this improves your working capital cushion, protects your debt service coverage ratio, and prevents negative cash conversion cycles during slow collection periods. Without this buffer, delayed payments from customers force you to use credit cards or lines of credit at high interest rates, which crushes margins and increases effective cost of capital. Example scenario, a digital marketing agency earning $180,000 per year loses 2 clients in the same month. They still need to pay salaries, rent, and tools. If they have $60,000 in OPEX emergency fund, they can survive 3 months while acquiring new clients. Without it, they face layoffs, service downgrades, or debt. This fund is the backbone of business survival during slowdowns and revenue shocks. Type 2, Revenue Replacement Fund for accounts receivable and sales shock protection. This fund exists for one purpose: when revenue is expected but not received on time. This is common in B2B models where customers pay after 30, 60, or 90 days. The longer your days sales outstanding, the more this fund matters. Example: a wholesale distributor ships goods worth $100,000 with a net 90 payment term. If that payment is delayed to 120 days, the business can't stop payroll or operations. A revenue replacement fund steps in to cover the gap. The size of this fund depends on your average accounts receivable, customer concentration risk, and seasonality factors. A good benchmark is 15 to 30% of annual revenue kept in a combination of liquid reserves and short-term instruments. Example with numbers. If you earn $1 million annually and 70% is B2B invoicing, you may keep $200,000 as a revenue replacement buffer. You use it only when customers don't pay on time or when seasonal dips happen. This prevents you from draining working capital, taking expensive short-term loans, or defaulting on supplier payments. From a financial stability perspective, this fund improves your liquidity ratio, net working capital, and cash flow adequacy ratio. It also keeps relationships healthy. Vendors trust you, employees feel secure, and banks increase your creditworthiness. Many businesses fail not because clients don't pay, but because they do not survive the wait. A revenue replacement fund solves that. Type 3, Asset Breakdown and Maintenance Emergency Fund. If your business depends on machinery, vehicles, servers, refrigeration, CNC tools, manufacturing lines, delivery vans, or production equipment, this fund is non-negotiable. Equipment failures create operational downtime, spoil inventory, delay deliveries, and damage customer confidence. This emergency fund covers repairs, maintenance, replacements, and rentals during breakdowns. A common benchmark is 3 to 10% of annual fixed asset value allocated for emergencies only. For example, if a packaging company owns machinery worth $1 million, they should reserve $30,000 to $100,000 for breakdown and maintenance emergencies. Let's apply a realistic situation. A food processing unit has a sealing machine that breaks mid-production. Replacement parts cost $8,000. A 1-week downtime means revenue loss of $15,000 plus customer dissatisfaction. With an asset breakdown fund, repairs are done same day, downtime is minimized, and operating cycle stays intact. From a finance perspective, this fund protects operating capacity, asset turnover ratios, gross margin stability, and continuity of production cycles. It also reduces the need for emergency loans with high annual percentage rates and prevents compromised deliveries that lead to chargebacks, refund claims, and penalty clauses. This fund works alongside insurance but is not a replacement for insurance. Insurance claims take time and don't cover everything. The Asset Breakdown Fund fills the gap between incident and reimbursement. If your business relies on physical assets, ignoring this fund is extremely costly. Type 4. Legal, Compliance, and Surprise Obligations Emergency Fund. This is the fund for things you never expect, but always happen eventually. Legal notices, surprise tax liabilities, compliance penalties, software renewal deadlines, license expirations, statutory audits, cyber breach recovery, or insurance deductibles. Example scenario. A small e-commerce brand receives a data privacy compliance notice. Legal consultation costs $4,000. Fixing compliance systems costs $6,000. Without this fund, the business either delays the fix or takes expensive debt, both of which increase risk. Recommended size: 5 to 10% of gross annual revenue, allocated toward legal and compliance contingencies. For a business making $300,000 per year, this means $15,000 to $30,000 set aside. Here are typical expenses this fund covers: lawyer and CPA consultation, contract dispute resolution, intellectual property filings, tax reassessments and penalties, insurance deductibles, license and certification renewals, software security fixes, industry compliance audits. From a financial analysis viewpoint, this fund protects regulatory risk, compliance exposure, reputational capital, and business continuity resilience. It keeps your balance sheet clean by avoiding emergency liabilities and helps maintain a stable creditworthiness profile for future lending. Businesses operating in regulated sectors such as healthcare, finance, food, manufacturing, or data-driven software as a services are especially vulnerable without this fund. When you combine these 4 emergency funds, you create a financial safety net that keeps your business alive during crises.